A 6.25 investment-grade corporate bond with a 30-year maturity. Is this something to consider for building a retirement income stream? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So we post regularly in our VIP member zone about new issue agency and corporate bond offerings and other promising investment opportunities that we come across. And one of the most recent corporate bonds from Jefferies Financial Group was of particular interest, given its 6.25% coupon, the highest on Fidelity's list of new issues at the time of this taping. It also comes with an investment grade rating and a 30-year maturity, which may be relevant as well. And especially in light of the fact that many of our Diamond NestEgg regulars seem to be expecting lower rates in the foreseeable future. The recent federal investigation and threat of criminal prosecution of Fed Chairman Jerome Powell doesn't really help matters either. There's clearly a lot of uncertainty around rates. And no one knows where this will go. But against this backdrop, it's no surprise that some of our Diamond NestEgg regulars are considering locking in current rates, which, as I've mentioned often on this channel, are still quite attractive if we compare them to the averages over the past 20 years. So, with that in mind, here are the 3 topics that we'll be covering today. 1. What business is Jefferies in, and how are they doing? 2. Can you lock in an income stream for 30 years with this Jefferies bond? And 3. Would Marcus and I invest in Jefferies personally? Let's dive in now, folks. What business is Jefferies in, and how are they doing? Jefferies may not be a household name for the wider population, but we have spoken about them before on our channel because they are a frequent issuer of corporate bonds that are specifically aimed at retail investors and offered on selective platforms, including Fidelity, like the bond our members have asked us about. The industry often calls these offerings retail notes, and they come with several user-friendly features, such as a price and coupon that are fixed and guaranteed for everyone who subscribes during the offering period, so you know exactly what you will get when you place your order. In comparison, if you participate in a treasury auction, or any traditional bond auction for that matter, you will only know your exact price and yield after the auction. So back to Jefferies. They describe themselves as the leading pure-play investment banking and capital markets firm. Jefferies is headquartered in Midtown in New York, has a balance sheet of $76 billion and a bit less than 8,000 employees globally. Jefferies is also listed under the ticker JEF on the New York Stock Exchange with a market cap of around $13 billion. Jefferies is a relative newcomer to the world of big investment banking in New York. It was founded by Boyd Jefferies in 1962 in Los Angeles as a small equities trading shop, but they really took off in 2001 when Richard Handler became chairman and CEO and moved the headquarters to New York. Handler is still currently the chairman and CEO, and he's a bit of a legend on Wall Street for a style that is both informal, personal, and blunt at the same time. But Handler is also famous for a business approach that can be described as either competitive and driven, or, as some media have done occasionally, as an eat-what-you-kill culture. And perhaps that's what it took to break into the top league of investment banking against all the larger and more established competitors. In any case, Jefferies has built out a strong position in many markets, not least in areas such as healthcare and middle market banking, often serving mid-sized companies that need professional investment banking products and services, but may sometimes feel a bit too small for the largest banks. As Jefferies proudly points out in its last shareholder letter, they have advanced into the 6th rank for both global advisory and global equity capital markets, 2 core businesses for investment banks, and are right at the heels of Citigroup. So let's see what Jefferies' latest numbers look like. They have a financial year that ends on November 30th. And while they haven't filed their official 10K yet with the SEC, they already published some key results for 2025 in a shareholder letter and accompanying news release just this past Friday. And do note that their tables generally show all amounts in thousands of dollars, but we'll round them to the next million or billion to make it easier to follow. Let's go through some key numbers on revenue and profitability first. Jefferies' total revenues, the top line, or how much it took in from all its businesses, were up 3% in 2025 versus the year before, growing to $10.8 billion from $10.5 billion. That said, total non-interest expenses grew even a bit faster by 7%, up to $6.5 billion versus only $6 billion the year before. In fact, every single cost line was up, except for cost of sales, which went down slightly to $191 million from $206 million last year. Higher costs predictably resulted in net earnings attributable to shareholders, their net profit in the bottom line shrinking by 6% to $631 million from $669 million the year before. So overall revenues are a bit better and net profit is a bit worse for 2025 versus 2024, but it's roughly all in the same range. And seen from a long-term perspective, Jefferies is continuing on a path of long-term profitable growth. Despite some ups and downs along the way, net revenues increased by an 11.9% CAGR, compound annual growth rate, since 1990, and net earnings even a bit faster by a 13.9% CAGR. The only unprofitable year over this period was 2008, when they showed a loss of $541 million at the outset of the Great Financial Crisis. Now, with the cautionary note that we need to wait for the official 10K before we can see the details of their balance sheet, including how much they've really lost so far on their well-publicized involvement in the First Brands disaster, the surprising, almost overnight bankruptcy of an automotive supplier in September 2025. None of these numbers that we've just shared with you raise any warning signs from the perspective of a bond investor. And credit analysts seem to be in agreement. S&P, Moody's, and Fitch all give Jefferies investment grade ratings in the BBB range, towards the lower end of investment grade, but still a clear sign that they don't expect them to run into trouble with their debt anytime soon. And the OS in brackets here means that they also consider the outlook stable. If we take a quick glimpse at the share price though, as we like doing here at Diamond NestEgg, it initially went down after the results were announced and was overall down minus 3.5% versus a year ago at the end of last week. So not great for shareholders, especially after such an otherwise strong year in the markets. But from a bond investor's point of view, that's still a solid result. Remember, as bond investors, we're mostly concerned whether Jefferies will be able to meet all their upcoming financial obligations fully and on time. When we look at the share price, we're not necessarily trying to discover future growth potential, but we're more concerned about any red flags that might indicate deeper trouble, such as a share price that's relentlessly sliding down or even collapsing. But that isn't the case with Jefferies here from our perspective. So far, so good then. And it seems that the 6.25% Jefferies bond may stay on some of our VIP members' list of potential investments so far. And if corporate bond investing and learning how to read a company's financials, like what we've just done here, is interesting for you, I invite you to come join our brand new VIP member community at the lowest price it will ever be before we officially launch on January 15th. We kicked off our members-only mini-series on corporate bond investing in December, and we'll be continuing with this in January as well. You'll also be joining just in time for our very first VIP member live for 2026, which is happening this coming Sunday, January 18th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, with highlights of the upcoming 10-year tips and 20-year T-bond auctions. Check out this video here to get an insider look into the content and conversations that are happening in our VIP member community every day and whether it's something for you. Or visit our website at www.diamondnestegg.com and click on this yellow private VIP member community button to grab your $100 early bird discount before prices go up on January 15th. I've linked everything below this video for your convenience. For today's Jefferies video, though, let's move to the next question, especially if you're trying to build a stable income stream for the long run and or for retirement. Can you lock in an income stream for 30 years with this Jefferies bond? Now, the good news here is that the answer to this question is much quicker and simpler than to the question from the previous section. The bad news, though, is that the answer is no. You can see it at once from this no here in the call protected column. No call protection means that this bond is callable, and if we click on the no, we can see that the first possible call date is January 20th, 2031, so pretty much exactly in 5 years from now, and that Jefferies can call the bond every 6 months after this date. And whether to call or not is entirely in their discretion. There are no conditions or prerequisites. In case Jefferies calls the bond on one of these dates, you'll get 100% of the principal back plus all accrued and unpaid interest up to the call date. But of course, your income stream will stop at this point, and you will need to find a new investment for the returned principal. And it's probably a fair assumption that the issuer will only call a bond if interest rates at this point are lower than the coupon on the bond. So, you may not be able to fully replace your income so easily. Remember, my general recommendation is that you should only buy callable bonds if 1. You're okay with them being called anytime after the first call date and are not overly concerned about reinvestment risk if and or when that happens. And 2, if you're also okay with them never being called and that you may have to hold to maturity. If you check both of these boxes, and yes, they're somewhat contradictory, but if you can live with a callable bond being either called early or not at all, then callable bonds may be something to consider because of the extra yield premium they typically pay. Now, let's talk a bit about our personal perspective. Would Marcus and I invest in Jefferies personally? As our trademark saying goes, everyone's financial journey is different. But from my personal perspective, you might want to have a closer look at bonds like this one from Jefferies if you fall into one or more of these 3 categories. 1. You like the coupon. This is probably the main reason to buy for most investors. A 6.25% cash income yield for a 30-year bond is attractive at the moment. For comparison, the 30-year Treasury pays only about 4.8%. And the 5-year Treasury, which matches the first possible call date, has an even lower yield of 3.75%. 2. You're comfortable with Jefferies as a firm and don't mind the volatile nature of the investment banking business they're in. The firm's long-term track record of profitable growth and success in breaking into big investment banking may also help here. 3. You're okay with the BBB investment grade rating and the stable outlook, and don't insist on a rating that starts with an A. On the flip side, bonds from Jefferies might not be for you if you cannot live with the callability. The rate is only locked in for the first 5 years, and after that, Jefferies can call the bond every 6 months at their discretion, which means you don't know in advance whether your money will be tied up for 5 years, 30 years, or somewhere in between. You live in a high tax state and don't want to pay your full ordinary income tax rate on the interest. As a reminder, the interest on treasuries and some agency bonds is exempt from state and local taxes when held in a normal taxable brokerage account. You're looking for inflation protection. If inflation was to actually go up again and the Fed started to raise rates to fight it, Jefferies, as the issuer, would probably have no incentive to call a bond that now has a lower coupon than new issues at that point, which means that in such a scenario, you would be locked into a below market rate or have to sell at a loss. If inflation protection is a top concern for you, you may consider a look at TIPS and or I bonds instead. Personally, Marcus and I do like the coupon on this Jefferies bond, and we can get comfortable with its callability. So, if we were a bit older and looking to move more of our money into longer dated bonds for a stable income stream, this is one we would invest in as part of an overall diversified portfolio. But then again, both of us grew up in investment banking and financial services, so this is not a field that's completely alien to us. your circumstances, goals, and expectations may be different. In case you want to dig deeper into the 6.25% 30-year Jefferies bond so that you can decide for yourself, here's the QSIP, 47233WLH0. And as always, if income generation, capital preservation, as well as inflation protection are top of mind for you, and today's video has piqued your interest in corporate bonds, and you want to be equipped to do a similar analysis to what we just did on Jefferies with the corporate bonds that you find online, I invite you to come join our brand new VIP member community at the lowest price it will ever be. And to check out part 1 of our corporate bond investing series, where we walk you through how to find a company's financial reports and how to read them. Remember, if you already understand bond basics and are reasonably comfortable managing your own portfolio, or if you're currently going through our bond courses, our Diamond NestEgg VIP member community is the ideal place for you if 1. You're already in retirement and want to have a forum for an extra pair of eyes for critical questions. 2. You're not yet in retirement, but are actively thinking about it for yourself or a loved one and want to get ready to take the decisions that lie ahead. 3. You have questions about how a product works and what the benefits and risks may be. 4. You follow the markets and want to be the first to know about safe and/or higher yielding investments. 5. You want to understand new offerings and trends and decide whether they might be something for your portfolio. 6. You want to exchange perspectives with a like-minded community of safety-conscious and income-minded investors who do not want to give up on good returns either. And 7. You're a lifelong learner who enjoys discovering hidden gems and sharing with others in a more private setting. So, if you check one or more of these boxes, take a look at this video here to get an insider look into the content and conversations that are happening in our VIP member community every day and see whether it's something for you. Or visit our website at www.diamondnestegg.com and click on this yellow private VIP member community button to grab your $100 early bird discount before prices increase on January 15th. They will never be this low again. I've linked everything below this video for your convenience. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.